You will likely be aware that one of the main economic risks in the US in 2024 is inflation. Inflation has been at its highest levels in generations in recent years, and the impacts of rising prices on people's finances has been devastating. In June 2022, inflation reached a 40-year high of 9.1%, and while it has declined in recent months, it's still not fully under control. While the potential impacts of inflation can be alarming, it doesn't have to be all bad news. There are people we can learn from, such as Charlie Munger, who understood how to turn periods of high inflation into periods of big opportunity. Charlie Munger was a billionaire investor and the right-hand man to Warren Buffett. Munger was an expert in using times of rising prices to get even richer, and, at the time of his death, had an estimated net worth of $2.6 billion. In this video, we will explore how you can protect your money against the devastating impacts of inflation, and we will set out the simple strategies you can follow to make huge profits out of the challenging situation we're currently in. In order to tackle inflation, you must first understand it. Inflation is the rate at which prices increase over a given period of time, and is the broad measure used to understand the overall increase in prices or the increase in the cost of living in a country. In simple terms, inflation measures how much more expensive goods and services have become over a certain period, usually a year. To figure out how much prices have changed, government agencies look at a bunch of different items people commonly buy and see how their prices move over time. This is known as the Consumer Price Index, CPI, and it is used to help us track inflation. There are typically two main causes of inflation: demand pull inflation and cost push inflation. Let's take a look at each in turn. Demand pull inflation occurs when demand for certain goods and services is higher than the price of these services. When demand increases beyond a specific limit, it becomes difficult for businesses to meet the orders within the given time. As a result, businesses put up their prices to try to reduce demand to a level they can meet. The increase in prices due to such demand results in inflation. On the other hand, cost pull inflation arises when there is a shortage in supply of a good or service. The producers of that good or service are inclined to raise prices when there is a supply shortage. This results in inflation, where the purchasing power of customers is reduced. Since the 1980s, the US economy has enjoyed many years of low inflation and even deflation, which is prices dropping and otherwise known as negative inflation. For a long time, there were concerns about inflation being too low, which, although sounding good, can actually be harmful for the economy. As a result, the US Central Bank, the Federal Reserve, set an inflation target of 2% in 2012 in an attempt to keep a low and steady rate of inflation in the US economy. The Fed managed to keep inflation at or below this target during most years since 2012, but this all changed in 2020 and 2021. In order to prevent a widespread economic disaster following the coronavirus pandemic, the US Federal Reserve started supplying trillions of new dollars into the US economy. The Fed's goal was to keep markets functioning after they were spooked by the global pandemic by promoting economic growth and making debt cheaper. This worked in the short term and prevented an economic collapse. But one of the major downsides of supplying more money in the economy is inflation. When the Federal Reserve attempts to stimulate the economy by growing the money supply, prices will increase over time, the cost of goods will be unstable, and inflation will likely occur. Following the Fed's effort to stimulate the US economy, the Consumer Price Index rose 6.8% between November 2020 and November 2021, driven by price increases for gasoline, food, and housing. Higher energy costs caused the inflation to rise further in 2022, reaching a high of 91% in June 2022, a high not seen since 1981. This now begs the question: how do you tackle this inflation problem? One of the main tools available to central banks to combat inflation is interest rates. Interest rates are the price of borrowing money. When interest rates are low, it's cheaper to borrow money for things like buying a house or starting a business. But when inflation starts to climb, a country's central bank, like the Federal Reserve in the United States, might decide to raise interest rates. They do this to slow down the speed of price increases, as higher interest rates make it more expensive for people and businesses to borrow money, discouraging consumer spending and discouraging companies from taking on debt to finance expansion. Higher interest rates also make saving more attractive, further reducing consumer spending. This can help keep inflation from getting too high. So, how should you navigate the investment landscape during inflation? Inflation is most damaging to investments, like savings accounts, that offer a fixed rate of interest because as inflation rises to match or even exceed the interest rate, investors are, in effect, losing money after adjusting for inflation. This is known as the real rate of return. Let's use the example of Paul to explain the concept of real rate of return. Paul is nervous about investing his money and so is super happy to find a savings account that pays a fixed 5% interest per annum. Paul puts $10,000 into the savings account and waits a year. After 1 year, Paul checks his savings to see that he has earned 5% multiplied by $10,000, which equals $500 in interest. At first, Paul is happy with this return on his investment, but he soon realizes he's forgotten to factor in inflation. Assuming inflation is at the target rate of 2%, Paul has actually earned 5% minus 2%, which equals 3% on his investment. While not as good a return as he originally thought, Paul has still earned a $300 real return on his investment of $10,000. But now consider if inflation rises to 5%. At an inflation rate of 5%, Paul's real return on his investment is 5% minus 5%, so 0. In other words, while Paul was initially super happy with the 5% interest rate he is earning on his savings, thanks to the devastating impacts of high inflation, Paul's money is actually not growing in value at all. To avoid falling into the same inflation trap as Paul, let's now look at some of the key strategies you can apply to build your money, even in periods of high inflation. Strategy 1. Look to non-diversification for higher returns. Charlie Munger said, "One of the best ways to generate above-average returns is to have a concentrated portfolio of only your best investments." Diversification means spreading your money around in different types of investments to reduce risk. But sometimes, investors like Charlie Munger take a different path. Before his passing, Charlie Munger's entire portfolio was invested in the following few assets: Berkshire Hathaway stock, Daily Journal Corporation stock, Costco stock, and a real estate portfolio in California. Now, why would someone not want to spread their risk? The idea is pretty straightforward. When you invest in companies and truly understand their financials and business models, rather than just picking stocks, you will have strong conviction in those companies' ability to weather economic storms over the long term. If those investments do well, you could earn a lot more money than if you had your money spread out across a large number of companies or even the whole market. While many would argue that a portfolio consisting of only a few assets is too risky and not properly diversified, Charlie Munger's view was, the whole secret of investment is to find places where it's safe and wise to non-diversify. It's just that simple. For regular people, like you or me, looking to grow their wealth during inflation, taking a page from Munger's book could mean choosing a few areas to invest in that you know well and strongly believe in. And that takes us on to strategy number 2. Strategy 2. Invest in asset-light companies. An asset-light business is a business that does not require a high investment in physical assets in order to produce its goods or services. Examples of asset-light businesses include Uber and Airbnb. Uber is asset-light because its business model is based on being an intermediary between users and drivers, without having the cost of owning a large fleet of cars. On the flip side, asset-intensive companies require large and continual investment in its asset base to keep generating profits. Examples of capital-intensive industries include car manufacturers and airlines. The airline industry is very asset-heavy as it requires a fleet of very expensive aircraft in order to operate. And those aircraft depreciate quickly over time, meaning they need regular maintenance and replacement. As a result, a large chunk of the profits made by airlines have to be reinvested each year into increasing and maintaining its asset base so the company can remain competitive in the future. Asset-intensive companies suffer during high inflation as the price of the physical assets they employ go up and up. Compare that to an asset-light business, like a financial services company such as Bank of America. Bank of America was one of Charlie Munger's favorite stocks. The US bank does not need to constantly invest in physical assets to provide its services. All it needs to do is rent office space and buy furniture and basic technology equipment for its employees to utilize when providing services to its customers. As a result, Bank of America is less impacted by the forces of inflation, and there is plenty of profit left over each year for the bank to invest in new business ventures or distribute to its shareholders. Strategy 3. Invest in commodities. One of the best assets to invest in to provide great protection against the effects of inflation are commodities. Commodities are raw materials either consumed directly or used to manufacture finished goods. Examples of commodities include gold, silver, oil, and even soybeans or coffee. Generally, the demand for commodities tends to be high during periods of high inflation, which pushes up commodity prices alongside rising inflation, preventing inflation from eating away at your investment returns. You can invest in commodities by directly purchasing them. For example, buying gold bars or barrels of oil. However, when you directly purchase commodities, you will need to physically store them. Not only do they take up a lot of space, there is also a risk they can get stolen, lost, or otherwise spoiled. Fortunately, there are much simpler ways to invest in commodities, such as futures contracts, commodity stocks, or investing in commodities through a commodity ETF. As inflation is still not under control in the US, commodities remain an excellent choice of investment to benefit from price rises. Strategy 4. Don't discount the bond market. The bond market is where people lend and borrow money. When you buy a bond, you're lending money to the government or a company, which promises to pay you back with a little extra in the form of interest. But when inflation goes up, the bond market faces some challenges. First off, when prices rise, the money you get back from bonds doesn't buy as much as it used to. This makes most types of bonds less attractive during high inflation. Also, when inflation rises, higher interest rates mean new bonds pay more interest than old ones. So, if you have an old bond that pays less interest, it's not worth as much if you want to sell it. This can make the bond market challenging when inflation is high. You might therefore be wondering why we would recommend them during a period of high inflation such as this. Well, the good news is that even with these challenges, there are ways to use the bond market to get rich, especially during inflation. One strategy is to look for bonds that adjust for inflation, known as Treasury Inflation Protected Securities, or TIPS, in the United States. These bonds increase their payouts with inflation, helping to protect your money. When the CPI rises, so does the value of a TIPS investment. Not only does the base value increase, but since the interest paid is based on the base value, the interest payments increase with the base value increase. Direct investment in TIPS, for instance, can be made through the US Treasury or through a brokerage account. They are also held in some mutual funds and exchange-traded funds. Strategy 5. Real estate. Real estate is a popular choice during periods of high inflation because it provides a useful store of value while generating increased rental income. Investors can buy real estate directly or invest in it by purchasing shares of a real estate investment trust, REIT, or specialized fund. Home rentals involve buying a house or apartment and then renting it out to other people to live in. When you own a rental property, your tenants pay you rent monthly. This rent can cover the costs of the mortgage, taxes, and maintenance, and should leave you with extra money in your pocket. As landlord of the property, you would have the right to increase the rent charged on that property, allowing the rent you receive to keep up with inflation. However, if you don't want the hassle of managing tenants, REITs are a way to invest in real estate without having to buy a whole property or building yourself. When you invest in a REIT, you're buying a piece of a company that owns, operates, or finances income-producing properties. This means you can make money from real estate like office buildings, apartments, and malls without the stress of being a landlord. During times of high inflation, the company that owns the property will likely increase its rent, allowing your investment returns to stay the same in real terms or even grow. So, there you have it, the strategies you can follow to protect your money from the devastating impact of inflation and get rich in 2024. If you found value in this video, please hit the like button. Don't forget to subscribe and click the bell icon so you won't miss out on more content. Until next time, keep building your wealthy life.